The first stock to keep on your radar is India's largest private airport developer GMR Infrastructure, which has entered into a definitive agreement to sell its 40% stake in Istanbul's international airport for about 200 to 250 million euros, which is roughly 2,500 crore rupees. Though it needs the approval of both the partners, where Malaysia Airport Holdings owns 20% and Limak Holdings owns 40% in Istanbul's international airport. Separately, GMR Megawide Consortium has also emerged as the top bidder for Philippines' international airport, though it is yet to officially win the project, as advanced evaluation of the bids are still underway. And the GMR Megawide Consortium has bid 14.4 billion Philippine pesos for the airport, where GMR, which currently has a group debt of about 33,000 crore rupees, will have 40% equity interest in the consortium and invest 80 to 85 million dollars, which is roughly 450 crore rupees in this project. Also, the company has appointed Citigroup and JP Morgan amongst other 4 banks to manage the listing of its airport business, where it is looking to raise 300 to 350 million dollars through its airport IPO, as per reports. Keep a tab on Mahindra & Mahindra, which has raised the prices across its product portfolio by up to 2%, which will be effective come January, which is in line with other automobile, domestic as well as international players over here. And the company has said it needs to do this because of the higher input as well as the freight costs. India's largest national bank, SBI too, has said that it will be issuing 1 crore and 12 lakh preference shares to the government at about 1,782 rupees and 74 paise per share, which is in line with its preferential allotment of 2,000 crore rupees to the government in order to better comply with Basel III regulations. And lastly, fertilizer companies will also be in action today, as the cabinet has given its nod for the banking arrangement with regards to the fertilizer subsidy payment, and has therefore approved a clearing of 4,800 crore subsidy. Well, the markets remained in correction mode for the third straight day, but the broader markets fared better than the benchmark indices. And amongst the stocks which were most active in trade, you had Tata Power and Tata Motors from the large cap and Bata India from the mid cap space. So Tata Power charged up more than 4%, bucking the trend on a dim day, and bounced up after taking support at the 200-day moving average after a 2-day decline. Now, there has been no news or a change in fundamental trigger to back this up move, but its shares were clearly in demand, and it turned out to be the leading gainer amongst the peer companies as well as on Nifty, backed by 3-month high volumes. On the other side, you had Tata Motors, which skid more than 4% and lost traction for the third straight day. So the 25% jump in the JLR sales for the month of November clearly did not cheer the investors and was overshadowed by the concern that the capex of the company, which will be increased to 3.5 to 3.75 billion pounds in FY15 versus a flat guidance of 2.75 billion pounds, is something which will squeeze the cash flows of the company, because it will be required for expanding the capacity at the UK plant as well as setting up new facilities in China and Brazil. So even though the thrust on R&D as well as product development is positive in the long run, these challenges will remain a concern in the short term, and that is why it slipped the most amongst auto peers on Nifty and was dragged down by 1-month high volumes. Lastly, Bata India jumped up 2.5% and found some support after a 5-day fall, as the management said that their upgradation of the product mix as well as raising the average sale price of the product is yielding results even in an environment when the footfalls remain weak and the same store sales remain tepid.